So in this section, we're going to look at the midweek reversal and also the trend continuation. Now, what this refers to is, in our last lesson, you learnt that after 3 levels of rise or 3 levels of fall, smart money will tend to do one of 2 things. They will either reverse the prior trend after a stop hunt out of level 3, or alternatively, they will continue the prior trend. Okay, so the reversal of 3 levels of rise or fall we call the midweek reversal, and if they choose to continue the prior trend, we simply refer to this as a trend continuation. And we're going to take a look at an example of both of these processes. So the midweek reversal. Now, the midweek reversal can happen on any day of the trading week, and is a reversal of the dominant weekly trend after 3 levels of rise or fall. Now, for example, once smart money have completed a weekly bull trend over the course of, say, 2 to 3 days, the midweek reversal would change the direction to a bear trend. Okay, so we've seen 3 levels of rise, we go into level 3 accumulation, and then the market reverses and we see 3 levels of fall, and that is simply a reversal of the prior trend. Now, the reversal is not guaranteed and is dependent on smart money's fundamental outlook of the particular currency. So just like with retail traders, obviously smart money are going to be analyzing particular currency pairs at any one moment in time, and they're going to have their opinion as to whether the pair is going to be bullish or bearish over the short term. Now, if we see 3 levels of rise and the fundamental outlook on the currency pair is bearish, then out of level 3 accumulation, smart money are going to accumulate sell orders. We're going to see manipulation of the retail orders to the upside, inducing traders into the wrong side of the market. Smart money will sell into this, and we will see the midweek reversal as a bear trend unfolds. On the flip side, if we see 3 levels of fall and the fundamental outlook on the currency pair is bullish, then during the level 3 accumulation, smart money are going to accumulate buy orders, induce sellers into the market, buy into this pressure, and then the midweek reversal will unfold in the form of a bull trend. So the fundamental outlook on a currency pair will determine whether we're going to see the midweek reversal or if we're going to see the continuation of the prior trend. Now, the midweek reversal offers a swing trade opportunity. If the start of the midweek reversal can be identified and entered, an intraday trade lasting 2 to 3 days can be entered with a potential of 150 to 300 pip gain. So all this means is, if we can identify the midweek reversal, and we looked at an example of this in terms of catching phase 1 of a trend. So out of the level 3 accumulation, we're going to identify manipulation to both sides of the market, and our intention is to catch the midweek reversal or the trend continuation from phase 1. So if we identify that smart money are going to manipulate the market from a bull to a bear market, our job will be to recognize this manipulation during level 3 accumulation and catch the midweek reversal of the trend as it begins. And this will allow us to enter an intraday trade for the new cycle of 2 to 3 days. Now, if you think about the process that takes place during the intraday cycle, where we see accumulation, manipulation, we see 3 levels of rise or fall, and then we see the New York reversal. This is no different to what is taking place in regards to the midweek reversal, but we're seeing it during the weekly cycle. Okay, so the midweek reversal in a sense can be seen as the weekly cycle's New York reversal. Okay, they are different, but the process in terms of the structure is the same. During the intraday cycle, we see 3 levels of rise or fall during the London session, and then we see a reversal of the trend during the New York session. During the weekly cycle, we see 3 levels of rise or fall over the course of 2 to 3 days, and then we're going to look for the midweek reversal, which is a reversal of the prior trend. And we're going to take a look at an example of the midweek reversal. Okay, so in this first example, we're looking at the euro dollar on the 60-minute chart. And during the weekly cycle, we have 3 moves to the upside. So on Tuesday, we have our phase 1. On Wednesday, we have our second phase. And then on Thursday, we have our third and final stage. And we now know that after 3 levels of rise or fall, we're going to be expecting the market to go into accumulation. And on Friday, we can see that we have the sideways price action, which is a characteristic of accumulation. And during this process, smart money will be analyzing the euro dollar currency pair, and depending on the fundamental outlook of the currency, they're either going to reverse the bull trend, and we're going to go into a new bear or downtrend, or they're going to continue the uptrend. So if the fundamental outlook on the euro dollar is positive, then during the accumulation period, they're going to be accumulating buy orders. Okay, so during this period, they're going to be accumulating buy orders. Obviously, on the flip side, if the analysts at the institutions come back and they have surmised that the euro dollar is looking bearish and the fundamental outlook is to the downside, then during the accumulation period, they're going to be accumulating sell orders. So the midweek reversal is going to be a move opposite to the prior trend. So in this case, we have a clear uptrend. So if the fundamental outlook on the currency pair is to the downside, we're going to expect to see our midweek reversal. And again, the midweek reversal can occur on any day of the week. So we have Tuesday, Wednesday, Thursday, which are our 3 levels of rise. Friday is the accumulation, and then on Monday and Tuesday we can see the reversal of the trend. Okay, so smart money, in terms of their fundamental outlook for the euro dollar, would have been bearish. So during the accumulation period, they would have accumulated sell orders. Now, there is a clue in terms of what their fundamental outlook will be, and we get this in terms of the stop runs. Okay, so we know that during level 3 accumulation, it's impossible to tell what smart money are accumulating. But during the accumulation period, we can see that most of the activity occurs at the resistance area. We have multiple pins and breaks of the resistance. Now, we know that this will induce retail traders into the buy side of the market. So just by knowing that fact, we can change our bias as to what the next move of the trend will be. If we see that they're inducing buy orders into the market, we can surmise that there's a high probability that the next trend to occur is not going to be a continuation of the prior, but a midweek reversal to the downside. And as these buyers come in, their orders are absorbed, and then we can see that we have our 3 levels of drop to the downside. Now, as we know, if we are able to catch phase 1 out of the accumulation zone, we will be able to trade an intraday position for a 3-day cycle. So the midweek reversal can occur on any day of the week and will be seen after 3 levels of rise or fall. What determines if we're going to see the midweek reversal is the fundamental outlook on the currency pair. In the second example of the midweek reversal, we're looking at the US dollar versus the Japanese yen, and we're looking at the 60-minute chart. So again, we have the same process. We have, in this case, 3 levels of fall to the downside over the course of 3 days. So we have Wednesday, Thursday and Friday, which completes a weekly cycle. So on the Monday, what do we expect to see? Well, we expect to see that sideways level 3 accumulation zone. Okay, and we can clearly see we have our accumulation zone and we have our characteristic W formation. So again, during this period, we don't know whether we're going to have a continuation of the prior downtrend or if we're going to see the midweek reversal and a new trend to the upside. So during this period, as stated before, the fundamental outlook of the Japanese yen will be analysed, and depending on what the analysts at the institutions determine will have a direct bearing as to what is accumulated throughout the accumulation period. So during a midweek reversal, the opposite is true in terms of their analysis. So they were prior to the accumulation zone in a downtrend with a bearish outlook on the currency pair. During the week, the outlook on the pair has changed. Smart money are aware of this. They have begun accumulating their positions, and on the downside or the support of the zone, we can see that we have a stop run of the lows, which will induce sellers into the market, allowing smart money to buy into this pressure and ultimately reverse the market. And as we can see, just as in the intraday trend, once we have 3 levels of rise or fall, we expect that reversal of the trend. And in this case, over the next week, Tuesday, Wednesday and Thursday, we have 3 distinct moves to the upside. Okay, so in this example, we had the midweek reversal take place on the Monday. In our prior example, we had the reversal take place on the Friday. So it can take place on any day of the week. The most important thing is that you expect either a reversal or a continuation. And if it's going to be a midweek reversal, we're going to see a new trend to the prior unfold. So we've taken a look at the midweek reversal, and we understand that it is directly connected to a change in the fundamental outlook of a currency pair. So we saw that with 3 levels of rise during the accumulation period, the fundamental outlook of the currency has changed, and we would see a bear trend unfold, which was opposite to the prior trend. But what happens in cases where the fundamental outlook of the currency pair remains the same? When this occurs, smart money will simply want to continue the direction of the prior trend. So as they go into level 3 accumulation, they will, in an uptrend for example, begin to reaccumulate buy orders, and then they will perform manipulation, induce traders into the wrong side of the market, and then buy into the selling pressure. Now, what's different about the stop hunt that occurs after a 3-day cycle and the continuation of the trend is that the stop hunt is generally extended. Okay, so we don't just see a stop run which breaks the high and low of the accumulation range by a few pips. We would generally see a stop hunt that looks exactly like a phase 1. And this phase 1, or this fake phase 1 as I should call it, is there to induce traders into the wrong side of the market. So once phase 1 has emerged from level 3 price action, this does not necessarily mean that this is the start of a new trend in the opposite direction. When smart money have completed a 3-phase trend cycle, the positions they choose to accumulate during the level 3 price action may be in the same direction as the prior trend. Okay, so the failed level 1 is an extended stop hunt against their intended direction to induce traders to take the wrong direction and create deep liquidity in which to buy or sell into. So it's no different to the process in which they use. We know that no matter what the structure or what the formation of price action is, the overall strategy and business plan of smart money is accumulation, manipulation, and then market trend. In terms of the weekly, it's always just done on a larger scale. So in terms of a trend continuation, we're going to see a failed level 1, which in many technical terms is called a correction. And once this takes place, this will allow smart money to induce the traders into the market, the retail traders, and then they can absorb these orders and then continue with the prior trend. Now, a common red flag and a warning that a potential phase 1 is about to fail is when the price range is quickly and aggressively retraced. Okay, so if we see a phase 1 and then we see a aggressive retracement of this first phase, this is a classic sign that the phase 1 is an extended stop hunt. That many times this retracement of phase 1 will reverse back into the range of level 3 accumulation. Now, this failure and sharp reversal of phase 1 will often take the form of a V-shape formation, and we will generally see the V-shape formation because of the quick and sharp nature in which smart money reverse the extended stop hunt. Okay, so once the stop hunt has been completed, there will generally be no further accumulation, but smart money will simply snap the market back into the direction of the prior trend. And we're going to take a look at some examples of the extended stop hunt. Okay, so in this first example on the dollar yen, we have 3 levels of rise to the upside. Now, as we know, after 3 levels of rise or fall, we enter into our level 3 accumulation zone. And during the accumulation zone, again, we have that classic M formation appear, which is a great telltale sign that we are in level 3 accumulation. And then look what happens. We have a stop hunt of the highs, which is inducing traders to the wrong side, and then smart money aggressively push the market down. Now, as the market stops and closes beyond the accumulation range, we would mark this as a phase 1. Okay, so in our example on the trading of the phase 1 and identifying the phase 1 of the weekly cycle, once we saw the accumulation range broken after manipulation of one side of the accumulation range, we would mark the phase down as a phase 1. But let's look what happens on the following day. So the following day, we have an immediate reversal and aggressive reversal of phase one. Okay, so our initial move down has been cancelled the next day by an aggressive reversal of our first phase. Now, if we were expecting the market to continue down and we were looking to catch the phase two, we would be looking for manipulation of the top of the following day's Japanese session or any resistance levels higher, and then once we saw manipulation, we would be trading to the downside, expecting the phase two of the new cycle. But where we see an aggressive reversal of the first phase back into level 3 accumulation, this is going to let us know that we are in fact in a new trend to the upside. So notice that as the market came down and we saw what looked like our phase one, that we have this V formation. Okay, and this is a classic sign that level one is about to fail. And once we see the retracement of the range, we're going to mark the new leg as phase one in the new trend. So once we see the retracement of the initial phase one, we can see the V formation, and then the market retraces the entire leg of the failed phase one. The reversal leg will become our phase one in our new trend to the upside. Okay, so even though it's traded back into the manipulation range, because we've seen an extended stop hunt of the accumulation level, and we've seen the induction of retail traders into the wrong side of the market, and smart money absorb these orders. Once the reversal of the failed phase one is complete, we're going to mark the new leg as the phase one of the continuation of the prior trend. Okay, and if we move this on, we can see that after the V formation, we can see that we have the market continuing the uptrend of the prior weekly cycle. In this second example, we're looking at the sterling against the dollar, where we have a clear level of accumulation which takes place over the course of 3 days. We then, on the fourth day, have an aggressive break of the lower level, which will induce the retail traders into the wrong side of the market. But then the same process takes place. We get a sharp reversal and retracement of the leg. Okay, and we can see a highly noticeable V formation which takes place, and then we get a break of the upper level of our accumulation zone. So if the market had closed and stayed below the support level of the accumulation zone, then we would have labeled this first leg as our phase one. But where we've seen that sharp retracement and that V formation and the move back into the zone, we're then going to label our new leg as phase one. And then as the market continues, we get our second phase to the upside. Okay, so the same process, we simply have our level 3 accumulation, we have our break of the zone, which we know is our largest stop hunt. We then get a sharp reversal back into the accumulation zone, which creates our very noticeable V formation, and then we label the reversal as our first phase, and then we'll be looking for our second phase to continue the smart money trend. So an important point in regards to the failed phase 1 and the extended stop hunt. Now, when phase 1 out of level 3 accumulation is identified, there is no way of knowing if it is going to fail and an extended stop hunt unfold. We should always expect the typical smart money trend to unfold until proven otherwise, and expect phase 2 of the cycle. So during level 3 accumulation, we've identified that the range has been broken and that the phase has closed outside of the accumulation zone. We would mark this as phase 1, and then the following day we're going to expect phase 2. Okay, so the following day on the intraday chart, we're going to be looking for manipulation levels and a trade in line with the typical smart money trend. So if we've seen from level 3 accumulation phase 1 to the upside, the following day we're going to be looking for manipulation of sell orders and the buying of smart money to complete the second cycle, and the reverse is true in a bear trend. Now, our safety net is when smart money reverse the failed one, no manipulation in the expected direction of phase 2 should occur during the intraday trend. Okay, because we're seeing a rapid reversal of the failed phase 1 or the extended stop hunt, there is no continuation of that phase, so therefore a stop hunt at our identified manipulation levels should not occur, and this will prevent us from entering a trade in the wrong direction. So in a nutshell, once you've identified phase 1 out of level 3 accumulation, you're always going to expect the second leg within the cycle within the same identified direction, because there is no way of us knowing until the event occurs that the phase 1 is actually an extended stop hunt.